Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me for the first time Peter Grosskopf. He is the CEO and Managing Director at Sprott Inc. Peter has more than 30 years of experience in the financial service industry. At Sprott, he is responsible for strategy and managing the firm's investment capital and lending businesses. His career includes a long tenure in investment banking, where he managed many strategic and underwriting transactions for companies in a variety of sectors. Prior to joining Sprott, Peter was president of Cormac Securities, and he has a track record of building and growing successful businesses, including Newcrest Capital Inc., and he was one of the founders there. And that was acquired by TD Bank Financial Group in 2000. Peter is a certified financial analyst, chart holder, and earned an honors degree in business administration and master's of business administration from the Richard Ivey School of Business at the University of Western Ontario. So, Peter, I'm really pleased that you could join us today. Thanks for coming with us.
Thanks for having me, Jay.
I want to start out by getting a sense of your views on gold, and then I want to explore some of the ways that listeners might avail themselves to the various opportunities that Sprott provides, perhaps as shareholders of Sprott or some of the many different investment vehicles that you have available. So let's get started with your views on gold, the metal. With 2020 vision, it's obvious that with a few exceptions, most investors who put money in the gold mining shares not fared very well in the last few years. And I'm recalling a chart one of your analysts presented to myself and other newsletter writers that were up in your office a few years ago, perhaps in 2016, when the price of gold had just risen off a horrible bear market. We peaked out at around 1,900 in 2011, then we went down to near $1,000, I believe, and then bounced off. Early 2016, it looked like we were off to the races again when we were up in your office. But since then, of course, we've come back a lot. I think we bounced we had a nice bounce early 2016. Where do you think we are now in these long-term, because we've seen long-term bull markets in gold. The chart that I'm referring to showed a big bull market with the S&P the S&P Toronto Gold Index. It went up 760% starting in 1982 till about 1990, I should say. Yeah, 1982 to 1990 or thereabouts. And then you had another 607% rise from 2000 until 2011. But then you have these short, really wicked declines. So where do you think we are now in the longer-term scheme of things?
Well, let's just start with gold then, Jay. Gold has had a difficult 8 years as it's kind of been in the penalty box, and the reason for that is that the balance of the markets, the really big markets, equity and interest rate markets, have been rallying. And gold tends to take a back seat and lose investor interest during those times because there's comfort that the world's central planners, if you want to call them that, have everything under control. And when you look at the last 8 years, it really looks as though things have been pretty good.
Yeah.
Economies have generally been okay. There's been some crises in international markets, but they've not really affected our big one here in North America. And employment growth has been strong, and so unemployment is low. And the markets themselves have responded vigorously. I mean, this has been an epic rally now for 8 years, and nobody feels in that kind of an environment that they need the insurance that gold really provides. So gold's been in the penalty box. Gold's been range-bound. It's been fighting a strong U.S. dollar in particular for the last 2 years. And for the last 4 months, just to focus on it, gold had acted very well as a hedge during the market corrections of November and December last year. But it's become hurt again by the fact that the markets have been on another roaring sort of 4 to 5 months path. So if you sugar that all off, I think the conditions now exist that it's on the pad of a tightly coiled spring. It's been waiting and waiting and waiting, and it will respond extremely strongly to the next crisis that might develop.
Yeah, the next crisis that might develop, but there, the minds and hearts of most investors, that's not something that's likely to happen until it happens, and then I guess that's why we call this an insurance policy to own gold, right? It's you don't really want it to happen. Who wants to have horrible things happen so that the price of gold goes up? I mean, that would be asinine. I'm sure that's not.
You don't want it to happen, but you do have to use your mind and logic and look at some of the underlying signs. And I would say there are some very troubling statistics or movements that you can track now, where you might very logically say the odds of a crisis in the next 6 to 12 months are actually quite high. And, I'll point some of those out now. Obviously, the one yesterday was the trade negotiation between China and the U.S., which really overlies a much larger structural battle that the two of them are having for world economic dominance. Mm-hmm. But if that's not going well, that becomes an economy slowdown type of risk that hadn't been expected. And that's what yesterday's movement was all about. When the markets got absolutely pounded, gold was having a great day, as you would expect it to.
Mm-hmm. Peter, this leads me to ask you, my friend and partner, Chen Lin, wanted me to ask you if the trade war lasts till the election, what's the impact to gold and the economy?
Well, the longer it lasts, the more risk there is that it's going to do permanent damage to the economy on both sides. And we've baked in certain, all of these huge movements are really studies in what happens at the margin. And what happens at the margin if you get this trade war rhetoric and the tariffs coming in at the margin, economic activity slows, S&P earnings slow, and risks start to crop up with emerging markets and their ability to sustain their debt loads and what happens with their currencies. So everything at the margin goes the wrong way. So that's the risk. And again, gold providing good insurance to that. I want to point, though, Jay, at a couple of things that are even more important in the long run, in our view.
Yes.
And that is the fact that just look at the debt load and the interest burden that we've put on the economy and the future generations at the lowest ever interest rate levels.
Yes.
So what happens with that? And supposedly, while economies are quite good and bull markets are in full sway, again, what happens at the margin when either economies slow down, tax receipts slow down, or interest rates go up? I think you know the answer. At the margin, it very quickly becomes a huge problem. And what we've seen in the last 5 months is direct evidence of that problem, because when the markets were starting to crater in December, why did the Treasury Secretary call the heads of the banks? Why? I mean, you can't even think of a scenario other than to tell them, we're going to put the accelerator back on. Don't worry, because we're going to rescue this market, and we're going to tap some dovish comments and tweet some of this and tap some of that and start the programs again. And that's exactly what they did. And that was the warning call. That call by the Treasury Secretary, I forget what day it was in December, was to say, okay, we got the message. We cannot sustain any more damage. We're going to start tapping the accelerator again. And that, to me...
Yeah.
And the backdrop to that is really politics. There is not an economy or a political system in this world that can become reformist right now. It's all going populist. And those populist government elections and that we're seeing, whether they be right wing or left wing, are doing one thing in tandem, and that is printing money. So we think the trend is that the world can't get off this supply of fuel now, and there's just going to be, what do they call it, modern monetary theories coming out the yin-yang now, and there's going to be massive deficit spending, and there's going to be massive money printing, and that's what it takes now at the margin to sustain this debt load.
And massive money printing, Peter, means massive debt increases, too, because it's not as if there's not two sides of the ledger. You know, there's the asset and the liability, right? So every time we create money, because money is manufactured from debt.
Call it debt. You just print it.
Yeah. You don't call
it. But, I mean, there's... It doesn't matter because, you know, the burden of the economy and the future generations just take the extra currency and make it work somehow. Like it's magic.
Well, that's what they think. But could we see a Weimar Republic, a Weimar Germany kind of a thing, or you don't have to go that far back in history. There's plenty of them more currently. But the U.S. as the world's reserve currency, as long as we have the world's reserve currency, Peter, can't we get away with this? And how do we retain the world's reserve currency?
Well, we can get away with it to an extent as long as we're the world's reserve currency, although there's a lot of factors at work to change that. But, of course, it all comes down to inflation expectations, and when does it become apparent to me as a participant in this economy that prices are going up far more than Treasury bonds are yielding, and so I don't want to own Treasuries anymore. And when
we
that
can't
happens,
be far from that. We can't be far from that
when
now.
That happens,
I would think
rates go up. And when rates go up again, the equation gets worse, the printing gets more, and you're into that vicious cycle.
Right.
So I would suggest we're actually not that far away from seeing the start of it. You know, one of the things that I complain about a lot that has delayed it is the constant references to the low numbers around the CPI index. And as we all know, nobody that's operating in our markets can survive on the CPI. The actual rate of inflation is a lot higher.
No doubt.
And so holding Treasury bonds, whether you're holding them in the U.S. or whether you're holding bonds in Germany or whether you're holding Turkish bank deposits in Turkey, as a consumer, your money is already being repressed. Your cash is already being eroded. Your buying power is disappearing. And so our view on gold is full stop. It is a better than dollar cash equivalent. Why would you want cash in the bank when you know you're suffering losses to have that?
All right, so Peter, I would like to get on to some of the products, some of the opportunities that Sprott provides for investors. You can buy gold, you can put it away somewhere, you don't get any return on your investment. But that's okay longer term because, as you just said, it's a superior cash holding than the dollar even. But I would like to suggest, and I'd like you to talk a little bit about the products that Sprott offers. But Sprott Inc., you can buy it down here in the States under SPOXF, trades in Toronto and in Canada under SII. $2.25 I saw today, 253 million market cap. Or 253 million shares, about a 570 million market cap, and I believe you're paying a dividend, aren't you, Peter? Something like 4% or something like that?
Yeah, that's correct. We've done that since the company completed its IPO.
So tell us a little bit, it's for the investors that aren't familiar with Sprott Inc., tell us what your business model is, what you do. You have a whole lot of things that you're involved with that you're doing mostly in the resource sector, mostly in the precious metals space, I believe.
Yeah, so we are an asset manager investment firm in the gold space primarily. We also cover other mined commodities globally. And as an asset manager, we have management fee income over the asset and deposits that we manage. It's not unlike a royalty company.
Mm-hmm.
We sit on top of about 10.5 billion Canadian, or call it 8 billion US of assets, and we collect, in some cases, a very small fee, and in some cases, a slightly higher fee from that stock of investments. And then we have certain operating expenses, which are mostly in Canadian dollars, while our revenue is mostly in US dollars. Mm-hmm. And the balance is margin, and that margin pays what effectively is like a royalty as our dividend stream. Mm-hmm. And we have some free cash as well that we use to invest in building our business every year. Mm-hmm. And so for our shareholders, what we want to provide is upside exposure to this sector. And we have that in three leveraged ways. One is operating leverage. So we have a relatively fixed expense base. And obviously, if gold or gold investments go up, we make more margin. So we have that leverage. We also have the leverage of investment sales. So if gold becomes more popular, we can create more units to our funds, and mm-hmm. we can benefit from those inflows. And that's the second, amount of leverage on our income statement. And the third mm-hmm. would be performance fees. If we do very well for our clients, we can start to collect performance fees from our investors, and then we have almost an exponential return, like we did in the year 2010, which was the last year of the gold bull market, and in which we earned $200 million in performance fees.
Wow, nice.
So you can see the power of leverage.
Yeah, the power of $200 million compared to your current market cap is pretty significant.
Yeah, that was a Canadian dollar quote I gave you there on the 200, but mm-hmm. it is
even so
significant against our market cap.
Yeah. So on your asset management, who are your clients in that business activity? Are they corporate clients? Or?
We have about 150,000 clients globally that are retail investors that invest directly in our more liquid funds, and those mm-hmm. clients are mostly in the U.S. In certain cases, we have funds that are listed on the New York Stock Exchange carrying our physical bullion, and they're competitors to the GLD. Mm-hmm. And in other cases, we have some of the world's largest institutions that invest with us, and they'll buy anything from bullion to highly specialized private equity style strategies in mining, including making loans to mining companies and buying private, mining deals. So everything in between we have, from some very large institutions to some direct family office and high net worth and even small net worth investors. Mm-hmm.
Yeah, so your physical bullion trust that you have the CEF, that's the gold and silver. The gold, it's PHYS. The silver bullion ETF is PSLV. And you also have a platinum and palladium, I think SPPP. I would imagine that one's not terribly active, but boy, must have done pretty well with palladium performing as it has.
It did do well from palladium. All of the physical trusts have been a little bit quiet, because if you look at the overall movement of customer dollars into physical trusts in the last 2 years, it's been pretty flattish. Mm-hmm. You haven't seen retail investors really taking into physical metals lately, again, because of the conditions in the rest of the markets, and because other areas like Bitcoin and cannabis shares really captured the attention mm-hmm. of more aggressive investors. So the trusts have been pretty quiet, but they've been quietly doing their job, which is to protect value by storing that metal and being liquid on the exchange.
All right, Peter, with just a couple of minutes left here, less than 2 minutes, you've got the gold miners. You've got a couple of gold share ETFs, gold miners and junior gold miners. Can you tell our listeners what makes them unique, or are they unique compared to some of the other ETFs in that space?
Well, they are. The ETFs that we run are governed by a screen, which screens them for growth, revenue growth, and production growth, and also for balance sheet strength. So our ETFs will notably outperform the GDX ETFs, which are our primary competition at certain times, and at certain times they lag. It kind of depends on the exact nature of the market we're in. We like to think of ours as better long-term value pickers.
Okay.
And
we'll have to leave it go at that,
Peter. Liquid, and they're in ETF form.
Yeah, we'll have to leave it go at that. I wanted to ask you about the Sprott Focus Fund, the Sprott Resource Holdings. Perhaps we can have you back to talk about those. Those are public companies that our listeners could invest in as well, from what I understand, and they look kind of attractive to me. So we'll want to talk to you again sometime in the near future about those things. Peter, thank you so much for being with us.
We'd be happy to do that. Thank you, Jake, for having me.
All right.